we have learned how to budget our money and keep track of it, we will learn how to earn money with our money and learn the final step in managing your money, investing.
Investing is the act of allocating funds to an asset or committing capital to an endeavor with the expectation of generating an income or profit, aka putting money towards making more money. This doesn't mean letting your money sit in the bank and gain interest. It means sometimes you can invest in things like education. You put money forth to eventually make more money.
The most important thing you should know about investing is that there are risks. You might lose money or not gain the amount you first wanted.
People who face risk with a good attitude are risk tolerant or risk takers. They know how much they can lose, but they also know how much they can gain.
People who face risk with a negative attitude are risk averse. They do not think the gain would be worth how much you can lose.
Before you invest anything, you need to know how much you're willing to risk. You can figure out how much risk you can handle with these 3 questions. What do you want to accomplish? How much time do you have to accomplish it? And how does your personality affect how much you're willing to risk?
Now, there are many ways to invest, so let's get to learning them. First, a savings account. This is when you loan money to a bank and they will pay you interest in order to borrow your money. You can only make 6 withdrawals per month though.
Next, a money market account is very similar to a savings account. It's insured by the FDIC and you can leave your money in it for as long as you'd like. However, a money market account may have some additional restrictions. You may be allowed fewer than 6 withdrawals per month, perhaps only 3, and your account may also need to have a minimum balance.
A certificate of deposit, or a CD, is a lending investment in which you lend money to a bank at a set interest rate for a particular period of time. Typical time frames can be as short as 28 days or as long as 10 years. With CDs, you are guaranteed a certain rate of return, but you can't access your money before the end of the time period without paying a penalty.
Next, bonds. While a CD is offered by a bank, a bond is offered by a government or a corporation. A bond is similar to a CD in that it's lending investment at a set interest rate for a particular period of time, such as a year, 10 years, or longer. With a bond, however, you don't pay a penalty if you withdraw the investment amount before the end of the time frame. You just lose the money you would have received if you left it in for longer.
Investors who are not afraid of risk often put their money into ownership investments. These are investments that provide owners rights in return. Types of ownership investments include stocks, mutual funds, real estate, entrepreneurship or business opportunities, and collectibles. Let's take a look.
A stock or share says you own part of a corporation. As an owner or shareholder, you have the rights and responsibilities of ownership. This means you can attend shareholders' meetings, vote for issues you support, and receive a portion of the company's earnings. In addition, you may be able to sell your stocks for a profit, making a sizable sum of money. But being an owner also means you risk losing money because the stocks can decrease in value.
If you're concerned about the risks of owning stocks, you can invest in a stock mutual fund. A stock mutual fund is a combination of stocks from different corporations or agencies, usually from different industries. The idea behind mutual funds is that you don't have to take as much of a risk as you do when you buy individual stocks, but as an owner, you still have a good chance of receiving return.
Another ownership investment is real estate. You can buy a home to live in, a vacation spot for the summer, an investment property that will bring in rent money, or land that might be developed sometime in the future.
You might not realize it, but the money it takes to start and run a business is an investment. Entrepreneurship is one of the riskiest and hardest investments a person can make. This is because it involves a lot more than just money. Entrepreneurs invest their time, their hard work, and their ideas, and also their hopes and dreams. When a business fails, the entrepreneur loses a lot. However, entrepreneurship carries the potential of a very high return.
Collectibles are items that gain or lose value over time. For example, you buy a baseball card when it's not too expensive, and you want to wait for it to become really valuable. Once it's worth a lot more than you paid for it, you'll sell it to someone else to make a profit.
Now that you have learned about investments, you can earn more money and eventually pay us back for the $1 million knowledge that we have given you. Just kidding, but thanks for watching these videos. We really appreciate it. Thanks for watching Financial Literacy for You.